Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. I was scrolling through the comment section, going to answer some of your guys' questions, comments, or make comments to your comments. How about that? So it says, if you're looking at a housing shortage, would mortgage real estate companies do well because housings are selling like hotcakes, or poorly because uh, the supply of houses are low? What I would be looking at are the home builders. The home builders, when you kick onto an expansionary phase of real estate, and we're right at the beginning of one, the home builders would be a good spot to look at. And what home builders? I can throw out a couple names. Hovenen, HOV. I think they do like more apartment type stuff. You've got KB Homes. KBH is the ticker symbol. LGIH. They're a builder in Texas. MDC or MDC Holdings. Those are some builders that I look at and I own. So those are ones that I think will do pretty well in a housing market that's doing quite well. Other spots that would do well are real estate investment trusts that they'll make money off of rent. I do think rent's going to go up, and it has gone up, and it will continue to go up in an inflationary environment where we are short homes and people are, competitively trying to get rentals. I think that's another good spot. But I don't have any good suggestions there because I don't really invest too much in the REITs. I have a little bit in the home builders. It's not a ton because I think oil and energy is a greater leverage to play the commodity boom than some of these home builders. But I do have some of the home builders, and some of them have done incredibly well. Would it be possible to elaborate about why higher interest rates would create a rush into oil assets, as you described at 850? So I'm not saying specifically oil assets, but oil is included in commodities. What happens is people, when higher interest rates go up, it puts pain on those who own bonds. They are literally going to lose money. They're going to lose their principal. In an increasing interest rate environment, bonds get discounted lower. And if you want to see what happens, you can look at the ticker symbol TLT, which is a 20-year bond index or fund. And that's going to decline over time as interest rates go up. And quantitative easing, the whole purpose of that is to hold interest rates down. It's to hold these asset prices up in stocks and bonds. That's what they're doing. And there may be other reasons why they're holding the interest rates down. Could be a variety of things with debt-related stuff. But if interest rates were to go up, and they don't hold them forever, you're going to see assets starting to move. They're going to move from ones that are very inflation-sensitive assets, which are stocks and bonds. They like low interest rates because it pushes the multiples of their price-to-earnings ratios up for stocks, and it pushes bond prices higher because existing bonds with higher interest rates get valued higher under a lower interest rate environment. More people value the higher interest payments and payouts. Conversely, it's the exact opposite when interest rates go up. People don't want to hold bonds because now you can get new bonds with higher interest rates. The cash flows are going to be getting larger and larger with new bonds being released at higher interest rates. And the principal, the value of the existing bonds, which were valued very highly in a low interest rate environment, will come back down. The valuations will go down when interest rates go up. So people are going to fear that movement. They're going to feel the pain of those bond prices going down if they own bonds. And I don't know who the heck's owning bonds at this moment. They all are in real negative territory, I think. And they're going to seek inflation-protected assets. Inflation-protected assets, like oil, is going to be things that people are going to seek. Now, oil, hardly anyone owns any oil. I mean, it's in relationship to history. It's like 2.5% is what's in people's portfolios. At more of a high, it's more like 16%. So the money's not there. We know that. And there's ESG coming out. There's a whole bunch of different things where money's not going to go into it. But the problem is oil's basically the foundational it's the foundational supply of energy that comes into this market and supplies energy to the market. And right now, we're kind of cutting off that foundational energy. The market can't survive without it. In my opinion, renewables cannot replace oil. And we are not far enough along in the journey of the EVs, not even close, to replace enough oil from transportation. And they're not being adopted that fast. Everyone thinks it's just going to come on in and swoop in, but there's too many shortages in the minerals that EVs are going to have. The grids aren't, in my opinion, upgraded, so to speak, to handle all of this new electrical demand. So there's that. It says, Andy doesn't shave until the markets turn green. I hope it doesn't turn into a full beard. I did shave, guys. Sorry. I shave like once a week. I'm pretty lazy with that stuff, to be honest. I'm not a guy who keeps up every second. And I'll be honest, I don't really, my looks are not a total high priority. It's probably, better that I think about it now that you guys see me every day. But so SVM Stephen Van Meter called a gold silver crash silver to 18. Okay. Stephen Van Meter thinks that bonds are going to go up, but whatever. I mean, I'm definitely not in his camp. And guys, I'm not claiming that this stuff's just going to go straight up. I'm not claiming that. What I'm claiming is this stuff is incredibly cheap. And we're coming into a situation from a demand supply perspective and also from an inflation perspective that these assets are going to get repriced quite differently. That market condition or environment. Now, Stephen Van Meter thinks completely different than I do. We are like polar opposites. This guy thinks that deflation's coming. I think that is absolutely ludicrous. I do not think deflation's coming. I think inflation's going to be here. And if the threat of deflation comes, they are going to print so much money, it's not going to matter. The system cannot survive in a deflationary environment for any length of time. Could there be a crash? Yes, but structurally underneath this, these commodities are needed and they're going to go up. I mean, that's my take. So anything that's going to be deflationary is going to be very short-lived if there is any deflationary thing. Now, everyone says, about all this deflation. The government stopped the economy. That was the problem. It was C-19. They stopped it. Would we have had that kind of blowout crash if they didn't stop the economy? Probably not. So it was man-made to begin with back in 2020. So everyone's so afraid about some recession. In my opinion, they come from the real estate market. A deleveraging in the real estate market is a deflation. And right now, when you look at the real estate market, it is hot. And we haven't gone to an expansion phase. We're like 5 to 10 years out from a crash, in my opinion. But again, guys, that's just my opinion. I could obviously be wrong with that, but I say 5 to 10 years, somewhere in that range. Maybe a crash will happen when the real estate market overproduces. Now, if they never overproduce, you might not get this big crash. It may just be like a flattening. So I am not in the camp of that. Now, could silver get down to $18 an ounce? Yeah, sure, maybe. Am I going to do anything different than what I'm doing today? No, I'm going to continue to buy platinum and silver and all these other things, and it could pull back. There's a couple people, even from chart reading, that think it could pull back. But the underlying, again, I'm going to go back. The underlying structural conditions under this market support higher prices. It doesn't mean that we're going to go straight up. It means that the conditions are there. So the way that I look at these things, and when I talk about conditions, it's like betting on, let's say there's the Formula One race, and they're racing their cars, and you've got the top drivers. They're out there. And this is the bet that you're going to make. It's been raining in the morning, but the rain has subsided. And it's not going to rain the rest of the day. The track is drying up. Now, the conditions changed. You went from raining to a drier track. Now, in that scenario, if you were to make a bet, would you bet that the lap times would go down or go up under raining conditions into more dry conditions. Do you think the lap times would come down? So that's the conditions that I'm looking at. I'm looking at we're going from we'll call it a disinflationary period or low inflation to a higher inflation period. And what I'm saying is the inflation assets are going to outperform in a high inflation environment. That means it's perfectly logical to think that way. That's like me taking the bet that the lap times will drop the drier the track gets. And when they put different tires on that are slicks versus their intermediates, they're going to drop even further. So my bet is that the times will drop. My bet is inflation sensitive assets will outperform in higher inflationary environment. That's all it is. And then when I look at the ratios are just validating that the money's not there. It's saying that they're cheap. And then when the ratios change against each other into a positive formation, it's a confirmation saying that inflation is coming, we have it, and that money's starting to rotate into it. So it's not a complicated, this isn't a very complicated thing to understand. Now, the things that we could debate on are the market conditions. Is it raining out? Is it not raining out? Is it disinflationary or is it inflationary? Now, some people have a vested interest in having a disinflationary period or a deflationary period. Their channel is set up around it, or maybe that's what they think is coming by whatever measurements they use. I think it's going to be inflationary because we've basically had that capitulation bottom on interest rates, where we had that big sell-off and bottoming pattern, which they usually happen. You have a blow-off top and you have a capitulation bottom, and that ends kind of an era. And we've got that ending look, we have that look where it ends. We have the capitulation bottom, it came back up, and now we're heading back higher. We're seeing higher CPI inflation numbers. We're seeing the M2 money supply go up, which is a leading indicator of inflation. We're seeing our inflation assets respond to it. Money is starting to rotate. And maybe we're in the very beginning stages. Maybe we still have a pullback left in this thing where people get scared. It could happen like that. I don't have, a crystal ball telling me what's going to happen. But I'm definitely betting that the overall structural market conditions are going to be inflationary. Also, if you look at the C19 sell-off, it was a short-lived sell-off and everything came right back up. Structurally, these things want to go up. There's shortages in the market from a supply-demand perspective on a lot of the stuff that we follow. And the conditions are changing to an inflationary environment, which we can see in the consumer price index. Now, how long will this last? We'll find out. Usually it's supported by an expansionary phase of real estate with new homes coming on. We are very early in that expansion phase. So that inflation is delayed behind it. And we need to ramp those new home builds up faster than what we're going to get, I would say, the inflation that is enough inflation to keep this inflation ball rolling. So we're very early and we could have a little dip in between. But I still think that the large movement in M2 money supply, that big old money printing that went up like 23%, I don't even think that's come yet. I think that's the wave that still is to come and will shock people into looking at things a little bit different. So, a lot of this deals with the psychology of people as well. And that big wave is going to shock people, and they're going to start to change their outlook and viewpoint and how they allocate money to certain assets. And we're just early on this. That's when you have to be early, because if you we're not that early. 2020 was a very good bottom for like energy and a lot of these other commodities. So we've got really good gains from that, and I think that we're back to where we were in 2018, which is like super low, still kind of at the beginning of a commodity boom. We just took a little detour down for the C19, which gave us incredibly cheap shares. It says, I'm brand new to investing and learning a lot from you. Thanks. I believe your thesis and invested in uranium and precious metals and copper miners and royalties, trying to get a setup right for the future scenarios. I live in Norway. Very low rates on loans now. With locking my interest rate causing rising inflation to eat away at the loan. and leave me with more dry powder to use in case of market correction. But in these politically troubling times, I also see merit in just paying off a loan and being debt free. Pardon my basic financial question, but would greatly appreciate your feedback. So there's other people who are new to investing. They were younger in their life. And usually what I tell people is right now, at least in America, and I can't say this for everywhere because I don't know everyone's market, we are going into an expansionary phase, which will probably last 5 to 10 years longer. I would say, yeah, it's good to buy a house with low interest rates, lock that in. And if you can live with roommates, they can pay off your house. So it's a whole bunch of positives there. One, you're building equity in a house in an environment where home prices are most likely going to go up. Then you've got people that you can rent to, because usually when you're younger, you're still single, potentially, or you're more apt to having roommates. If you have roommates and they're paying you, you could set it up where your mortgage is like $1,200 or $1,500 a month, something on the lines of that. You pay, charge them $500 per room. Let's say you have a 4-bedroom. You rent 3 of the rooms out. That's $1,500. It basically covers your entire mortgage. Then you split the utilities. Absolutely perfect. So really, you're gaining a house for free. You get to live there and be the landlord and make sure no one's damaging it. And you get to keep the house if you want to, live by yourself eventually. So I see it as a huge positive. That's a great way to build equity. It's a great way to let inflation eat away at that mortgage. And I think it's a really smart thing to do. I have recommended people do that to people that I know personally. Maybe I'll bring one of them on and you can see kind of what I recommended them over the years and see if it worked out. Like we can do a little interview, I guess, or well, speaking back and forth, asking them some questions about some of the information that I had recommended earlier. And this was some years back, maybe 3-4 years ago. Someone basically in the same situation that you are. He was very heavy in cryptos, and he actually rode it up a long way, and I think he sold out of them. And it'd be interesting to hear his viewpoint on why he sold out of cryptos. He bought a house, he had roommates and everything, and he still lives in the house. The house, in terms of equity, is probably up maybe $200,000 or more. So he's made $200,000 on top of whatever he's put into the house and built, paying the mortgage off. And I think he's done a very, very good job of doing that. And now he's riding the resource train, of commodity train, just like all of us. So it's building assets. You're diversifying your money out. It's a way to play a leveraged move on this inflationary environment. So I think it's great because you get to lock in your costs and you don't have to worry about the costs. But guys, it's going to have to fit your life. If you want to put down roots, if you want to, buy a house like that, then I would say go ahead and do it. If it fits within your investment strategy and it fits within the life that you want to build. And that's important. I mean, create a strategy for your life. A lot of people, they wander around aimlessly. They're not aiming at anything. Tell me what you want. Tell me if this fits within your life. Go ahead and do it. And guys, I can't give financial advice. This is just my opinion. So what I do is I say, what are we aiming at here? What are we aiming at? If we're aiming over here and we want to live in this area and the prices are cheap and the interest rates are cheap, I would let it rip. I mean, that's me. And I bought a house some years ago. I'm letting the inflation eat it away. I was lucky enough to identify this real estate cycle. I wish I identified it even earlier. Because remember, I was piecing this all together and no one really had any help. No one was helping me piece this together. I kind of did it all myself. And for a part of my life, I wasn't taking it that serious because I was, if you're in your 20s, sometimes you don't take things as seriously. And we didn't have access to information as easily as you guys do. Things were just, I would say, getting developed. They were just getting started. I don't even think YouTube was like, Google didn't even own YouTube when I first saw it. That was in the mid 2000s, I think, mid to late 2000s. And then they bought it out. And boy, man, they thought they made a lot of money. Imagine how much they would have made if they held on to it. Insane. But create a strategy for not just like investing, but for your life. Point and aim at something. Like go for it. And it doesn't mean, like with a lot of new investors, I think one of the things they do incorrectly is they think they can take all the risk in the world. You don't have to take all the risk in the world. You can go after investments that just push you going forward every single step. I like the physical metals game because that swapping ratios, and if you guys haven't seen it, maybe I'll put it in the description link below. But watch the swapping game. If you can swap metals back and forth based off of ratios, and you're going to have to go to a dealer and find out how to do that, or you can sell it to people through Craigslist or eBay or wherever you want to do, and swap it to other, swap that metal for another metal, and accumulate over time, swapping back and forth, increasing your purchasing power outside of the system. And you don't have to go after like small little exploration companies and lose your butt, because a lot of them, they don't perform that well. So you have to come up with investment strategies and portfolio allocation sizes for that to work quite well. But you don't have to take all the risk in the world. You don't have to do that. You just have to look and gain really, steady amounts. And the channel, when you look at some of our plays, like they've done pretty well. And I know in the short term here, we've had a pullback in a lot of energy and commodities in general and gold and silver, but we're early, and it's important to basically latch onto the thesis and the thought process behind it. If you can understand that logic and thought process, it's very easy to hold these assets and you won't get scared out of them. Everyone's is not immune to emotional responses to a portfolio going up and down. But if you're going to go for it, if you're going to swing for the fences, you're going to have to live with that volatility. It's just the way it is. It's part of the market. So you're going to have to change yourself. And another thing, it's you can put 100 baggers or 50 baggers or 20 baggers, whatever you want to call it, in front of you, but you're going to have to buy them and hold on to them. And that's going to take everyone who is going to hold on to those 50 baggers or 50 bagger plus. You're going to have to live with those big volatile movements. So you're going to have to develop yourself. You're going to have to be able to hold on to it. You're going to have to be able to figure out ways to be able to hold on, whether that's learning this stuff inside and out, the thesis, the ratios, how assets interact with each other. The quicker you can grasp all this earlier in your life, the better off you'll be in the long term. And if I were to set up my life and to do it all over again, I would buy a house, I would lock in the interest rate, I would get roommates to pay off that house. I would then start investing. I would buy a copious amount of physical precious metals that are low in the ratios. I would buy a bunch of that, and then I would go after some of the ones that I would swing for the fences. I would go after energy companies that have very good ratios like uranium and oil and natural gas. I would buy some of the small cap producers and let them go. And then I would also have some money in some companies that are doing well, that you physically see are doing well in the real world. And what does that mean? I would go after something like a Chick-fil-A. Chick-fil-A kills it. I know they're private. I know you can't invest in it, but the efficiency per unit that they have is absolutely incredible. They churn people like no other, and they're always busy. It's like they've got this huge line, and they get through the entire line, and there's another huge line comes. I'm like, God, they're so fast, and how is this line continually pumping through? It's ridiculous. I think Chipotle is another one that does very well. They're pretty high right now, but I mean, some of these companies, if you just buy them that you see growing in the real world, you're going to make a bunch of money. Then you just hold on to them. You don't ever sell them. And that could include other ones that you see in the world that are growing. It could be banks. It could be anything. You buy a little bit, you put it in, and you just let it sit in there. Then you got your commodity companies that are coming up with a bunch of the market conditions are going to be right for them. And these things can launch. I mean, they could be absolutely massive returners. But conversely, they also can get crushed quite bad if you get the market conditions wrong. So you have to have some sort of restraint. You can't go all in on one thing. And the precious metals, I've never lost on a precious metals bet. Granted, it's been cheap for a long time, but I just continue to accumulate and cost average in when it's cheap. wait until it becomes overvalued, which can take some years, 5 to 10 years, and then you sell it later on. Now, if I had just stuck to that, what I said right there, what I would have done earlier, I'd probably be 4 or 5, 10 times more wealthy, because I was trying to figure all this stuff out. Didn't really have a mentor, didn't really have anybody telling me any of this stuff. But I would have had a house earlier, and it would have been good because it was really low in 2012, 2011. That's probably because, remember, I didn't know anything about real estate cycles. I didn't know anything about ratios in the beginning of my investing career. I had to figure it all out, and it took some time. But if I had known that, I could have bought, a $400,000 house back then, which would be 1.3 million now on just the house. And I could have rented out to people, other than myself, and pay off the mortgage. And I'd be in a big old house. It'd be a nice house too. Very nice one. And I also would have played, if I knew the ratios, I would have bought even more of the physical metals when they were low. And I would be far more wealthy than what I am today. And obviously now I know what I'm doing. At least that's what I think I do. And I'm piling in because I know exactly where to go. I know what the cheap assets are. I know how to identify it, and then I'm piling in. And I'm playing the physical metals hard. I'm playing them hard, putting a lot of money in them because I think that they're tax kind of sheltered and they're out of the system. And I know that game works. I've never lost. So platinum, I'm not saying that you can't lose. What I'm saying is, if you have a long enough time frame to hold on, I think it will be an incredibly good bet. Incredibly good. And I think it's very low risk if you own the physical metal. This stuff is ultra rare, guys. Not many people own this stuff. And it's going to be industrial driven. There's not much, when this thing starts to move, there's not much to slow the move. It's not like people are just going to offload a bunch of silver, which they have, silverware and all sorts of stuff. They can offload that. A lot of people own it. Same with gold. Platinum, there isn't much. So once the momentum starts building, there's nothing really to stop it. And that's why palladium went through the roof and rhodium went through the roof. Both platinum group metals. We have the substitute here. It's like perfect. So I think that's a big opportunity there in platinum. And it's cheap against all the other metals, the ratios. So that's exactly when you want to buy it, in my opinion. So if you have the time frame and you're patient, accumulate this stuff when it's low like this, and just hold on. Just hold on. 5, 10 years out, you're gonna be laughing. You're gonna be like, okay, which one do we swap into? In my opinion, palladium would be the next one. That's probably what I'd swap into, given that the demand looks okay in the future for it. But that's the one that I'd be looking at. And these things they'll grow in their uses, especially the platinum group metals. Very high melting rates. We didn't know what to do with it in the history. Now we know how to melt it and work with it. And I think we're going to have expanded uses for it in the future. That's my opinion. So I'll stop it there. Kind of got into what I would have done differently in the beginning of my investment career. But that's what I would have done, and I would have been a lot wealthier. If you guys like this content, give me a thumbs up. Subscribe to the channel if you haven't already. And thank you for listening. This is Finding Value.